Today, more banks are being put on the dreaded watch list. What does that mean for them? And what does that mean for you, the real estate investor? Hey, everyone, this is Mike Bonn with the Cash Flow Company. Today, we're going to go over what's happening in the lending community and how it's impacting all of us, and especially the real estate investor. So it's in the news, it's everywhere. The Fed keeps tightening things up, but what does that really matter and how does it impact the real estate investor? And number one, the impact on banks, especially the local banks. What's happening to them? We just got a report come out and it is saying that there's just 190 banks were just put on the watch list. What does that mean? That means there's 190 banks that could collapse if just one thing happened. And that one thing is just some deposits leaving their banks. So with all these banks on the watch list, how does that impact real estate investors? The number one thing is they're going to start lending less. So the impact is less money out there. And the less money means they're going to start swimming upstream, which means they're going for the best of the best, the people with more cash in the bank, more revenue, with better credit, all of those kind of things. And they're doing this because of their lending restrictions. Number one that's causing these lending restrictions are people are pulling money out of the banks. The banks are able to lend, and they're able to lend on a X factor. So a bank takes in $1 in deposits in a CD, in a savings account, and then they could lend out multiples of that. So 10 to 20 times that or even more to individuals, to businesses. So as all of these deposits, these CDs are now being pulled out of the banks. The Fed starts raising its rates, so the bonds that people can invest in now are more attractive than CDs. So people are moving from a deposit or CD into government funds. So more and more funds are leaving banks, so they have less to lend out. So that's number one. As people take out the money, less and less money can be lent out to everyone, including real estate investors. Number two is they have this whole book of debt out there that they booked 3 or 4, maybe 5 years ago that has an interest rate of maybe 3 or 4%. But they're paying 5 to 5.25% now for CDs, for savings accounts, all that stuff. So they're upside down. They're receiving 3 to 4%, but they're paying 5 to 5.5% or 5.25%. So you could see every month they're losing money. So they have to sell some bonds. They have to get rid of some of that old debt, which is once again getting rid of some of their assets that were performing before, but now they're not performing because they're upside down. Number three, what's causing banks to pull back, to lend less, to swim upstream, is their book of business that they have with mostly commercial accounts like real estate investors or businesses. They wrote a lot of 3 and 5 year notes to businesses at a low interest rate, maybe 3 or 4%. Those notes are now coming due. Those businesses are now being hit with interest rates instead of 3 or 4, somewhere between 8 and 10. Guess what happens? Not all those businesses can qualify. What do these banks do? Some of these notes are going to become non-performing. And the more non-performing notes on a bank's books, the controller, the government, requires them to, once again, put more capital, put more money aside to cover these potential loss in these bad notes. We have banks being pushed by all sides here. And what happens is they're in there trying to figure out how to correct this, how to fix this. And right now they're not focused on lending unless it's an SBA loan because that's backed by the government. Or it's the perfect client that has a lot of deposits because their deposits are going to help them lend more, that have a lot of revenue, that have a lot of experience. We see this daily here because we're getting more and more calls from individuals, from real estate investors who used to use banks, who used to use other lenders, and now they're calling saying, we've done 50 or 100 deals the last year. Now we're looking for new lenders. Why are they looking for new lenders? Because the banks are swimming upstream. They're getting the best of the best. And now that means some of the clients that the banks had are cascading down to some of the private lenders. So now the private lenders are seeing clients they haven't seen before because they were with the banks. So now they're becoming part of their client base, and they're now swimming upstream too. They're looking for borrowers with more experience, with more money down, with more liquidity. What's happening with the medium to small investor? It's getting squeezed. It's getting where lenders now are, instead of saying, we're going to lend you 75% of the ARV, they're starting to say, we're going to lend you 75% of the LTV. So that could be anywhere for you putting in another 20 to 30% on each deal if you even qualify now, because credit scores have gone up, reserves have gone up. And all of this is because the whole money pool, starting with banks, cascading over to the private lenders, they're shrinking. They're getting a little bit more conservative because they don't know where this is going. On the fix and flip side, we have to look at one other aspect, and that's where the consumer interest rates are going for those homes. When rates go up 5% like it has over the last 2 years, what happens is the ability for a borrower to buy a house goes down. 2 years ago, someone who could get a 2.75 rate could afford a $500,000 house. That same person now, with current rates, can only afford about a $295,000 house. That's what the end result, especially as real estate investors we're seeing out there, is the other side of this too, is affordability. It's not only what they can fit in their budget, but what do they qualify for? What are the DTI issues they're hitting up against their lenders? We are seeing a squeeze everywhere. That's what we have to manage. And those who manage it will do well, because what the squeeze does is it brings up more opportunities. We're going to see better deals where if you could get into a deal now and even hold it for 2-3 years, you're going to be set up really well. You could create a lot of wealth in situations like this because the majority of people are going to be cut out. They're going to be cut out of the lending world because of either their history, their cash, or their credit. So we see the squeeze in the traditional banking. So what that means is those who are well prepared with making sure they have cash, making sure their credit is at the top, and that they're doing good projects, they're going to find more money. But it's also something we've talked about before, is really opening up your eyes to other sources, stuff that's been around forever, which is, we call it real other people's money. It's something you need to look at to fund part or even all of projects. That means starting to look for people in our communities that could lend you $10, $20, $100,000. They're out there. We have been doing this for 15 years now, bringing in money of other investors who are just looking for a return. And sometimes it's 10,000, sometimes it's 100, sometimes it's $1 million. But whatever it is, it helps you be prepared for this. Because remember, we need more money. We need to make sure our credit is good, and we need the experience. But the money and the credit are going to be your keys to making sure you're in this game and playing as we go forward and as rates keep increasing. If you want help making sure you're set up correctly, everything from your business to your credit to your income, helping with OPM, all those kind of things, go check out our website, thecashflowcompany.com. We have some great downloads. You could go through the steps to find OPM. If you want more help, we're here to help you. We can coach you through it. We've raised millions and millions of dollars on that side. And we've also helped people make sure their credit is good and they have the lenders. We know the lenders, besides ourselves, who are out there and who will stay out there through the next 18 months to 2 years. So if you're looking to make sure you're set up correctly, go to our site, thecashflowcompany.com. Got a lot of free downloads. But if you really want coaching or to go through it, just reach out to me, Mike at the Cashflow Company, and I can walk you through, help you get that extra bucket of money of real OPM. Make sure your credit's in line. Make sure your business is set up correctly so you can take advantage of these times while others are left in the dust.